Welcome to the deep dive. Today, we're plunging into the compelling and often contradictory story of Zeta Global Holdings Corp, ticker ZETA.
Zeta, yeah.
If you've been watching the markets, you know something, well, pretty extraordinary is unfolding. This morning, June 23, 2025, Zeta shares are absolutely surging in pre-market trading, up a staggering 17%.
Huge jump.
It's a dramatic rise, fueled by what many are calling pure AI euphoria. But here's the twist, right? Just 7 months ago, this exact same stock was in freefall.
Absolutely hammered.
Decimated by a scathing short seller report alleging, deceptive practices.
Right.
So the central question for you today is this sudden rally built on rock-solid fundamentals proving Zeta's critics wrong? Or is it maybe a speculative frenzy overlooking very real and, frankly, unresolved risks from its recent past?
That's the million-dollar question, isn't it?
Exactly. By the end of this deep dive, you'll have the crucial insights from all our sources, empowering you to understand this captivating battleground stock. Every piece of data and analysis we share is contextualized to today, June 23, 2025.
Good stuff. Let's get into it.
Okay, so let's kick off our deep dive by really getting to grips with what Zeta Global actually does. We'll start with Chapter 1, Business Analysis. What exactly is their core business, and how do they aim to make sophisticated marketing simple for their clients?
Okay, so at its heart, Zeta Global operates around its proprietary AI-powered marketing cloud. They call it the Zeta Marketing Platform, or ZMP for short.
CMP, got it.
Think of it as a kind of comprehensive one-stop shop for massive enterprise clients. It pulls together all their customer identity data, layers in advanced AI, and then activates marketing across pretty much every channel.
Like email, social media.
Exactly. Email, social, web, SMS, even connected TV. It's really broad.
And how do they make money? Is it like a subscription?
Primarily, yeah. Their main model is software as a service, SaaS. Clients pay recurring fees.
Okay.
They do supplement that with professional services, but we're seeing this encouraging shift. Direct platform revenue, the core SaaS stuff, grew to 73% of total revenue in Q1 2025.
Oh, wow. That's up from
67% the year before. So good adoption of the main platform.
Makes sense. And what about the platform itself? Any recent updates? I hear a lot about AI.
Oh, definitely. Their flagship ZMP was relaunched back in 2019, but they're constantly innovating. In March this year, they rolled out AI Agent Studio.
AI Agent Studio, what does that do?
It basically helps marketers automate complex tasks using these intelligent AI agents.
Wow.
And then just weeks ago in June, they unveiled Zeta Answers.
Zeta Answer.
Yeah, it's an AI-powered intelligence engine. Tries to bridge that gap between just having data and actually knowing what marketing actions to take. They're calling this whole approach agentic marketing.
Agentic marketing. So the AI is actually doing stuff, not just analyzing.
That's the idea. Proactively making and executing marketing decisions. Pretty advanced stuff.
Okay, so how big are they? Who are their customers?
They specifically target large enterprise clients. The ones with complex needs, big budgets.
Right.
They measure success with scaled customers, clients spending over $100, and super scaled customers, those over $1 million.
And are those numbers growing?
Yep, solid increase in both categories in Q1 2025. Their land and expand strategy seems to be working. And here's the kicker. These scaled customers generate a staggering 98% of their total revenue.
98%. Wow.
Yeah. And their whole value proposition boils down to delivering predictable, profitable, measurable ROI, which, in this economy is exactly what marketers need when they're pressured to do more with less.
Okay, that makes sense. So they're offering measurable results to big companies.
Precisely. And what's compelling here is how perfectly Zeta Global is positioned within some of the most powerful, non-negotiable secular trends shaping the entire industry.
Secular trends? Like what?
Well, if we connect this to the bigger picture, you can see why the customer data platform, or CDP market, is just exploding. Projections are like over 30% compound annual growth. Could be a $60 billion plus market by the end of the decade.
60 billion. Okay, what's driving that?
It's driven by what I like to call a trifecta of trends. Really powerful forces.
A trifecta. Okay, lay it on me.
First, the inevitable end of third-party cookies. Google phasing them out, privacy concerns. It's a huge structural shift.
Right, everyone's talking about that.
It forces brands to get serious about first-party data strategies. Creates urgent demand for solutions like Zeta's ZMP. It's almost non-discretionary spend now.
Okay, trend 1, cookie death. What's 2?
Second, It's the transformative AI revolution. Generative AI is rapidly turning CDPs from just passive databases into active, intelligent prediction engines, analyzing billions of data points in real time.
And Zeta's jumping on that with their new products.
Exactly. AI Agent Studio, Zeta Answers,
Yeah.
they're capitalizing on this. And finally, number 3, the economic squeeze.
Inflation, uncertainty.
Right. CFOs are scrutinizing every marketing dollar. Budgets are shifting towards measurable ROI. And that's Zeta's core pitch, right? Tangible financial outcomes.
So cookie changes, AI, and budget pressure. That's a powerful combination.
It really is. These 3 forces are deeply intertwined, creating this massive tailwind for the whole sector.
But it can't be easy street. Who are they up against?
Oh, the competition is fierce. You've got the tech behemoths, Adobe, Salesforce, Oracle. They can bundle their solutions, make it tough.
The usual suspects.
Then you have specialized MarTech leaders like Klaviyo, HubSpot, and even ad tech platforms like The Trade Desk, Google's campaign manager. It's a crowded field.
And what about regulations, GDPR, CCPA, all that?
Yeah, the regulatory environment is, well, it's a double-edged sword.
How so?
Strict data privacy laws mean compliance costs, risks, headaches. But paradoxically, those same regulations make sophisticated CDPs like Zeta's essential for clients. They need these tools to navigate the rules and stay compliant.
So the regulations create complexity, but also demand for solutions like Zeta's.
Exactly. And it's important to recognize the barriers to entry here are pretty formidable.
Like what? Tech expertise.
Deep tech expertise, yes. Massive data infrastructure needed to process like trillions of consumer signals. And crucially, a proprietary data asset. Zeta's has been curated over 17 years. That's extremely hard to replicate. It's a significant moat.
So with that competitive landscape, what makes Zeta stand out, given those giants they're up against?
Well, they have several clear competitive advantages, I think. First, brand strength. Having John Sculley, the ex-Pepsi and Apple CEO, as a co-founder definitely adds a layer of credibility.
Yeah, that's a big name.
Second, their financial execution. You can't argue with 15 consecutive quarters of beat and raise results. That signals really strong operational discipline.
15 quarters is impressive.
It really is. Third, they benefit from cost advantages and economies of scale. The ZMP has this flywheel effect, right? More data makes the AI smarter, which delivers better ROI, which attracts more customers and reinforces itself.
Makes the platform stickier.
Exactly. Which leads to the next point. Network effects and high switching costs. For big companies, integrating Zeta is a major project. It gets deeply embedded. Switching out is costly, disruptive, creates durable revenue for Zeta.
So once they're in, they tend to stay in.
Pretty much.
Yeah.
And finally, their unique assets, patented software, advanced AI, and that huge proprietary opt-in data asset they've built over 17 years, all unified into a single platform they claim nobody else can really match.
Okay, that paints a clearer picture of the business itself. But of course, behind every company is its leadership. And Zeta Global's management team, well, they've certainly been battle-tested. Let's move on to Chapter 2, Management Evaluation.
Yeah, things definitely got interesting there.
The CEO, David A. Steinberg, he's a serial entrepreneur, built and scaled companies before. It is worth noting, though, his past includes Infonic, a company he founded. It filed for bankruptcy in 2007, shortly after he resigned.
Right, so he's seen both sides of the coin, success and failure.
And co-founder John Sculley, after 17 years. He officially retired from the board just this month, June 2025, though he's staying on as an advisor, still a notable departure.
Definitely a shift.
But the biggest test for management came in November 2024. Culper Research published this devastating short seller report.
Oh yeah, that hit hard.
It alleged deceptive accounting practices, things like two-way contracts where money kind of flows back and forth to inflate revenue, and round-trip transactions to fake sales.
Pretty serious accusations.
Yeah.
They even mentioned consent farms.
Consent farms, like tricking people into sharing data.
That was the allegation. And the market reacted brutally. Stock plummeted 37% that day, just cratered.
Wow. So this raises an important question. How did management respond to such a direct assault on their integrity? What did they do?
Well, their counteroffensive was swift and multifaceted. They immediately put out a press release calling the report riddled with misrepresentations.
Standard playbook, maybe.
Perhaps, but they followed up with a detailed point-by-point rebuttal. And crucially, they disclosed something important. A prior forensic review.
A forensic review? When?
It was overseen by the board's audit committee back in 2022 and 2023. And they said it concluded their practices were sound, financials accurate. They also highlighted an unqualified opinion from their auditor, Deloitte.
Okay, so they had external validation. But what about lawsuits?
Yeah. Despite that defense, multiple securities class action lawsuits are still out there. That's definitely an overhang.
So it creates this weird situation, right? A paradox of transparency and ethical reputation.
Exactly. On one hand, they disclose the review, they give detailed guidance. On the other hand, the allegations, especially the consent farm stuff, undeniably damage their reputation.
You still see it mentioned online.
Oh yeah. Negative comments on investment forums, things like, Zedeka's a real scam. Even if unverified, it shows they haven't fully won back market trust. Investors have to weigh the official story against that lingering skepticism.
But management didn't just rely on words, did they? They took action.
Right. They adopted a powerful show-don't-tell strategy. The board authorized a $100 million share repurchase program.
Sending a signal the stock is undervalued.
Exactly. And then, even more crucially, CEO Steinberg and other top executives bought shares themselves in the open market.
Insider buying, that's usually a strong sign.
It's often the strongest counter signal you can send to short sellers. Shows real conviction.
That's a powerful counteroffensive, definitely. But, despite the review and Deloitte's opinion, those class action lawsuits are still hanging around. How much of a red flag are they, really? Could this shadow still dampen the current AI euphoria?
It's a fair question. The lawsuits represent a real, quantifiable risk. Even if management feels they have a strong defense, it certainly contributes to the stock being a battleground.
Okay. Beyond crisis management, how does Zeta Global allocate its capital for growth? What's the strategy there?
Their strategy is squarely growth-focused. They explicitly prioritize aggressive investments in R&D. You see that with the AI innovation and in sales and marketing. They're choosing growth over near-term profitability.
Makes sense for a tech company in a hot market. What about M&A?
Mergers and acquisitions are definitely part of the playbook, like the Live Intent acquisition back in October 2024.
Live Intent. Did that fit well?
It adds capabilities, but Live Intent's customers are generally smaller companies. So there's a potential risk it could dilute Zeta's overall average revenue per user, their ARPU. Something to watch.
Okay. And dividends.
Buybacks. With no dividend, they consistently reinvest all capital back into growth. But they do use share buybacks strategically. Like that $100 million program, they bought back $25 million worth in Q1 2025, actively supporting the stock price.
Got it. Reinvesting for growth, using buybacks opportunistically.
Exactly. And what's truly insightful here, I think, is the core financial dichotomy of Zeta Global. It really comes through when you look at return on invested capital, or ROIC.
ROIC. Okay, what's the story there?
Well, if you look at a standard GAAP-based calculation, their ROIC is negative, around minus 5.88%, because they have GAAP operating losses.
Right, we'll get to the losses.
But if you use free cash flow in the numerator instead of GAAP earnings, their free cash flow ROIC is positive, a healthy 12.1%.
Okay, hold on. Negative GAAP ROIC, positive free cash flow ROIC. What causes that difference?
It's a critical insight.
Yeah.
It means while they're unprofitable by standard accounting, they're highly profitable from a cash generation perspective. The negative GAAP number is massively skewed by non-cash expenses.
Like stock options?
Exactly. Notably, $195 million in stock-based compensation in 2024 alone. That hits the GAAP bottom line hard, but it's not cash during the building.
So the cash return is good, that 12.1%. How does that compare?
It comfortably exceeds their weighted average cost of capital, their WACC, which is estimated around 8.31%.
Yeah.
So yes, from a cash perspective, they are indeed creating real economic value for shareholders, despite the GAAP red ink.
That's a really important distinction. Okay, so what does this all mean for the raw numbers? Let's take a deep dive into Zeta Global's financials in Chapter 3, Financial Analysis.
All right, let's crunch the numbers.
As of today, June 23, 2025, their market cap is hovering around $3.34 billion. Puts them squarely in mid-cap tech territory.
Mid-cap, yeah.
And today's pre-market surge, it's lifted the price to around $16.58. That's up over 16% just this morning.
The AI euphoria effect, definitely.
So revenue growth, you mentioned it was strong.
Exceptionally strong, actually. They're in hyper-growth mode. Revenue went from about $368 million in 2020 to over $1 billion in 2024.
Wow, over $1 billion. What was the growth rate in 24?
38% year over year in 2024. And remember that remarkable streak, 15 consecutive quarters of beat and raise financial performance.
15 quarters, that's consistency. What about 2025?
Their guidance suggests another year of robust growth, around 23.5%. Still very strong.
Okay, impressive top line. But what about profit margins? You mentioned GAAP losses.
Right, it's a nuanced picture. Their gross margin is healthy, usually between, say, 55% and 60%. So the core business makes money on each sale.
That's good.
But their operating margin is negative, minus 3.4%, and net margin is around minus 4.8%. This is a classic growth stage SaaS. They're strategically reinvesting all that gross profit and then some back into S&M and R&D.
Pushing for market share and tech leadership over immediate profits.
Exactly. But there is a positive trend. The GAAP net losses are narrowing, and they are forecasting GAAP profitability for 2025. That would be a major milestone.
Turning GAAP positive in 2025.
Okay. Now, you mentioned free cash flow earlier. Let's focus on that.
Yeah, arguably the most important financial trend for you to focus on here. Despite those GAAP losses, Zeta is a strong and rapidly growing free cash flow generator.
How much are we talking?
It went from about $10 million in 2020 to a substantial $92.1 million in 2024.
Big jump. And that difference from GAAP is mainly the stock-based comp. Largely, yes. That $195 million non-cash charge in 2024 is a huge driver. The key takeaway is the business generates significant real cash. Gives them flexibility for investments, buybacks, whatever.
Okay, so strong cash flow. What about financial stability? The balance sheet.
Well, they consistently have negative GAAP earnings, but like I said, the losses are narrowing. The balance sheet, however, is a fortress.
A fortress. How so?
Very little debt relative to assets. Their debt-to-equity ratio is low, just 0.29, and they have an exceptionally strong amount of readily available cash and equivalents. Their current ratio is 3.33.
Over 3.0 is very strong, yeah? Does
Yeah.
have a good cushion.
Absolutely. Significant financial stability and flexibility even if the market gets choppy. And just to reiterate, no dividend. Everything's going back into growth.
Got it. So valuation. How do we value a company with GAAP losses but strong growth and cash flow? PE is out, right?
Yeah, price to earnings isn't meaningful here. So we look at other metrics. Price to sales, PS, is currently around 3.11.
Okay, and price to free cash flow.
That's around 27.53. Now, these are, I'd say, pretty modest multiples
Modest comparative.
compared to larger, more mature peers. Like Adobe trading at, 25 times earnings?
Yeah.
Salesforce around 40x, Oracle 46x. Those are PE ratios. But directionally, Zeta's PS and PFCF look quite reasonable for its growth.
Suggesting potential for multiple expansion if they keep growing and hit profitability.
That's the bull argument, yes. Significant potential there.
And what about intrinsic value? Any DCF models?
Yeah, looking at a third-party educational discounted cash flow model, the base case intrinsic value for Zeta is estimated at $18.81 per share.
1881. Is there a range?
Here is. The range in this model goes from $15.12 on the low end to $22.51 on the high end. Key assumptions are WACC of 8.31% and revenue growth starting around 19% and slowing down over time.
Okay, so $18.81 base case, range $15 to $22.50 roughly. Good context.
Yep. Keep in mind, it's just one model, educational, but gives you a ballpark.
Right. We've unpacked Zeta's internal workings, the business, management, financials, but a stock's story is also shaped by how the market sees it. So let's pivot now. Understanding the external dynamics and what they tell us about Zeta's ultimate verdict. This is part 2, external dynamics and the verdict, and we'll begin with chapter 4, market sentiment.
Okay, how's Wall Street feeling about Zeta?
Well, analyst sentiment is overwhelmingly bullish. The consensus rating is basically moderate buy or strong buy.
Really? No sells?
0 sell ratings out of 15 analysts covering the stock. It's 11 buys and 4 holds.
Wow, that's pretty unified. What about price targets?
The average 12-month price targets range from about $24.77 up to $30.36, so implying significant upside from where we are now. But there is a wide individual range. Lowest is $15, highest is $45.
$45. Someone's really bullish. But yeah, what's truly striking here is the profound disconnect this creates.
Disconnect? How so?
On one side, you have these uniformly positive professional analysts, and on the other, a significant chunk of the market actively betting against the stock.
The shorts.
Exactly. Now, the recent news, the narrative around Zeta's AI push Zeta Answers, AI agent studio that's successfully driven this strong AI momentum story. That's clearly the main catalyst for today's big pre-market jump.
Riding the AI wave.
Definitely. However, there's still this persistent negative undercurrent. The ghost of that November 2024 short seller report hasn't vanished.
The lawsuits are still there.
The ongoing class action lawsuits are a material reminder, yeah.
Yeah.
And you still see skeptical chatter in public forums. It continues to cast a shadow.
So the market indicators must reflect this tension. What does the short interest look like?
It really paints this picture of a battleground stock. Short interest is significantly elevated 10.34% of the float.
Over 10%. That's high.
It's a substantial figure. It means a large group of investors are betting the price will fall. But high short interest also provides considerable fuel for a short squeeze.
Ah, the squeeze potential.
Right. A sudden surge of good news, like this AI hype, can force those short sellers to buy back shares quickly to cover their bets. That buying pressure pushes the price even higher. It's highly likely contributing to today's 17% jump.
So the shorts might actually be helping fuel the rally they were betting against.
Ironically, yes. Now, technically speaking, the stock is trading above its 50-day simple moving average, which is around $13.01 to $13.08. That's a bullish short-term signal.
Okay, positive short term, long term.
It's still significantly below its 200-day simple moving average. That's in the $16.33 to $19.85 range. So despite this rally, the stock technically remains in a long-term downtrend.
It hasn't fully recovered from the November drop yet, technically.
Not yet. It still has a way to go to repair that technical damage. It really feels like a tug-of-war playing out in the market right now between the AI bulls and the skeptics.
Fascinating dynamic. So who holds the reins at Zeta Global? Let's look at the company's ownership structure in Chapter 5. Ownership structure. Who actually owns Zeta?
Well, the top institutional ownership patterns show a clear majority is held by large, sophisticated institutions. Somewhere between 63% and 69%.
Big names.
Yeah, like the Vanguard Group and BlackRock. Vanguard holds nearly 10%, BlackRock over 7%.
So the big guys are holding firm. That's a vote of confidence, right?
It generally is, yes.
Yeah.
These firms do extensive due diligence. Their continued commitment, even after the short seller report, suggests they either dismiss the allegations or believe the long-term growth outweighs those risks.
What about insiders? Management owning shares?
Insider holdings are also very high, between 12% and 21%. And CEO David Steinberg personally owns around 11.6%.
Okay, so his interests are aligned with shareholders. Skin in the game.
Definitely. Now, recent insider transactions.
Yeah.
They tell a bit of a conflicting tale.
Oh, how so?
Remember, right after the short seller report, there was that strong bullish signal, coordinated open market buying by top insiders like Steinberg.
Right, showing conviction.
But more recently, there have been Form 144 filings, like one just a few days ago, June 20th. These indicate an intent to sell shares.
Ah, insiders planning to sell. That doesn't look as good.
It tempers the earlier bullish signal, for sure. Now, it could be for totally legitimate reasons, diversification, taking some profits after the recent run-up, but it's definitely a conflicting signal compared to the buying back in November, December.
So, a bit of a mixed message from insiders lately. What about overall concentration?
Ownership concentration is high. The top 25 shareholders control over 63% of the company.
Meaning
They have substantial influence. But it also means potential for increased stock price volatility if one or two of those large holders decide to buy or sell big blocks of shares. The price could swing more dramatically.
got it. High institutional confidence, high insider alignment, but with recent selling intent, and high concentration. Interesting mix.
Definitely adds layers to the story.
Okay. Now, no deep dive is complete without looking under the hood at the potential pitfalls, the risks. So let's do a comprehensive SWOT analysis for Zeta Global. That's Chapter 6, Risk Assessment. Strengths, weaknesses, opportunities, threats.
All right, let's break it down. First, Zeta's strengths. Number one has to be their technology and data moat. That unified AI-powered ZMP built on 17 years of proprietary first-party data. Very hard to copy.
Okay. Tech and data moat. What else?
Second, a proven growth engine. We talked about the consistent 20% plus annual revenue growth, their success landing and expanding those scaled enterprise customers, and that high net revenue retention, 114% in 2024. Existing customers are spending more. That's key.
Strong growth metrics. Strength 3.
Strong cash generation. We hammer this point, but it's crucial. Powerful and growing free cash flow despite the GAAP losses gives them real financial power.
Right. And fourth.
The fortress balance sheet. Very low debt to equity, high current ratio over 3.0. Provides exceptional financial stability.
Okay, those are solid strengths. Now, the flip side, weaknesses.
The most significant, I think, are the persistent GAAP losses. It's a primary concern for many investors, and it's largely driven by the second weakness. High stock-based compensation, SBC.
That $195 million in 2024.
Exactly. That leads to tangible shareholder dilution, which investors don't like. And the third weakness is the damaged reputation. That unresolved shadow from the short seller allegations and the ongoing class action lawsuits, it creates this cloud of suspicion.
Cap losses, dilution from SBC, and reputation issues.
Got it. What about opportunities? Where can they win?
Huge opportunities. First, the massive total addressable market. TAM. They're in these exploding CDP and AI-driven marketing industries, growing over 30% a year. Huge runway.
Playing in a big, fast-growing sandbox.
Right. Second, their land and expand strategy. Lots of potential to increase revenue just from their existing customer base by upselling more services. Third, the opportunity for disruption of legacy players. Their modern AI native platform can definitely gain market share from older, clunkier systems.
Taking share from the incumbents.
And finally, they could be a potential M&A target. Their unique assets, data, AI, could be very attractive for a larger tech company looking to bolster its marketing cloud offerings. Interesting. So big market, expand within customers, disrupt others, maybe get bought. Now, the scary part, threats.
Always threats. Number one is hyper-competition. Battling giants like Adobe, Salesforce, Oracle, Google, Microsoft. It's a constant fight for market share. Intense pressure.
Yeah, tough neighborhood.
Second, regulatory scrutiny. Those evolving data privacy laws we mentioned. They pose ongoing compliance risks and potential costs. Third, the AI arms race. They have to keep investing heavily in R&D just to maintain their technological edge, fall behind, and they're in trouble.
Constant need for innovation.
Absolutely. Fourth, macroeconomic factors. Inflation could pressure marketing budgets, though Zeta's ROI focus helps mitigate that. And higher interest rates increase their cost of capital and tend to push down valuations for growth stocks like Zeta.
Macro headwinds. Anything else?
One more, maybe indirect. Geopolitical factors. Think about the 2025 U.S. tariffs on IT hardware. Could that ripple effect crowd out client spending on software and marketing services like Zeta's if companies have to suddenly spend more on physical hardware? It's a possibility.
Okay, so competition, regulation, AI race, macro, and maybe even tariffs. Lots to watch out for.
Definitely a complex risk landscape.
Right. We've covered a lot of ground today. From the technical nuts and bolts of Zeta's business, the management drama, the financials, to the complex dance of market sentiment and all those underlying risks. So, what's the final takeaway for you? This brings us to our final section, Chapter 7, Conclusion.
Okay, conclusion time. If we try to connect all these dots, you can see a truly compelling bull case emerging. But, and it's a big but, you absolutely have to acknowledge the serious counterarguments.
Let's hear the bull case summarized first.
Okay, the bull case for Zeta rests on being perfectly positioned in high-growth markets, first-party data, AI, measurable ROI. Their stellar growth and flawless execution, 15 beat-and-raise quarters, growing enterprise base. The fact they're a true cash-generating machine despite JAP losses, that financial fortress balance sheet. Strong insider conviction shown during the crisis. And potentially being undervalued on growth metrics and that DCF model.
Okay, strong points. Now the bear case.
The bear case highlights those persistent gap losses and the significant stock-based compensation causing dilution. The unresolved credibility gap from the short seller report and the ongoing lawsuits. The intense battle against market giants. Those wavering insider signals with recent selling intent. And that deep-seated market skepticism reflected in the high short interest.
So, clear arguments on both sides. And just to recap the valuation, the educational DCF model we looked at put the base case intrinsic value at $18.81 per share, with that range of roughly $15.12 to $22.51.
Right.
So what's the concluding outlook? As of today's pre-market surge, Zeta Global stock price around $16.58. It's trading squarely within the lower half of that estimated intrinsic value range.
Right in the zone, yeah.
It undeniably remains a battleground stock. It represents a bet on high growth, clearly, but with significant undeniable risks. The market is clearly and deeply divided on this one.
Absolutely. High risk, potentially high reward. Classic battleground.
So, here's a final provocative thought for you. As the market continues to grapple with this tension between the AI euphoria driving the stock up today and those lingering past allegations, where do you think Zeta Global's story is headed next? Is it a phoenix rising from the ashes, or is the market maybe forgetting some critical lessons from its not-so-distant history?
Something to definitely chew on.
Indeed. If you found this deep dive valuable, we invite you to like and subscribe to the Stock Analytics AI YouTube channel. Remember, members paying €4.99 a month get priority deep dives on tickers. And over the next few months, we're covering all of the S&P 500 stocks with exclusive priority access just for our members.
Great value there.
Members can also add stock suggestions for future videos right there in the comments, and we will pick them up.
Awesome.
And finally, the important bit. This analysis was generated by an AI system for educational purposes only. It should not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.